I've been watching Wall Street sell you the AI boom story for 2 years, and I need to show you the number they keep glossing over. Tech's biggest names are on track to spend over $700 billion on AI infrastructure in 2026 alone, and they're increasingly funding it with debt, not profit. A balance sheet pattern that looks uncomfortably close to the one that destroyed portfolios in 2000. Two specific warning signals are buried in these footnotes: the ratio of capex to free cash flow at the hyperscalers, and the hidden leverage hiding in plain sight on their balance sheets. The 1990s infrastructure collapse wasn't an earnings story. It was a debt story. And that distinction is everything. In the late 90s, telecom companies poured over $500 billion into fiber optic networks, and almost all of it was financed with debt, not profit. WorldCom, Global Crossing, Nortel, they looked like growth machines right up until the moment the debt service outran the revenue. The income statement looked fine. The balance sheet was the bomb. And the same structural fingerprint is showing up right now in the hyperscalers' own filings. Amazon's free cash flow collapsed 66% in 2025, from $38 billion down to $11 billion, as capital expenditure hit $132 billion, almost all of it flowing into AI infrastructure. That's not a company funding growth from profits. That's a company burning its financial cushion to build. Alphabet's situation is sharper still. One research projection has its free cash flow falling nearly 90% in 2026, from $73 billion to roughly $8 billion, as its capex guidance runs as high as $185 billion, a figure that essentially consumes every dollar of operating cash the business generates. Microsoft's capex to operating cash flow ratio has already climbed past 50%. Combined, these four hyperscalers are targeting $725 billion in AI infrastructure spend in 2026 alone, up 77% from last year. Wall Street's response to all of this is, the revenue will catch up. That's exactly what the sell side said about fiber in 1999. The telecom build-out was real. The demand assumption was wrong, and the debt didn't care either way. It kept compounding, while the revenue didn't. That asymmetry is the first warning signal. But there's a second signal buried even deeper in these balance sheets, one the analysts on your television are almost never discussing. The capex to free cash flow squeeze I just laid out, does that pattern read to you as a temporary growth investment or a genuine balance sheet warning sign? Drop your answer in the comments below, because the second signal is actually the one Wall Street is working hardest to keep you from seeing. The tell in the 90s wasn't that fiber was laid. It was that 97% of it was never lit. The cables existed, the revenue didn't. And the debt that financed those cables didn't care either way. It kept compounding on a clock that ran independent of customer adoption. That utilization gap is exactly what's forming right now inside the AI build-out. And it's showing up in a market most investors never look at: the corporate bond market. In 2025, the five largest hyperscalers alone issued $121 billion in U.S. corporate bonds, more than 4 times their annual average between 2020 and 2024. These are companies that, until recently, barely needed the bond market at all. By October 2025, the total amount of debt tied to AI had ballooned to $1,200 billion, making it the largest single segment in the investment-grade market. It now surpasses U.S. banks, and here's where the balance sheet risk emerges. Some of that leverage sits at the fund level, not on the corporate balance sheet, meaning the debt doesn't appear in the 10K or retail investor reads. The income statement looks clean. The exposure is real. Meanwhile, AI represented only about a quarter of all data center workloads in 2025, with training driving most of the demand, not the enterprise revenue adoption that would justify multi-decade debt commitments. The capacity is being built for a customer base that is still, by most measures, in early innings. Credit rating agencies have already flagged that a continued shift toward debt financing could prompt outlook revisions or downgrades if the expected returns on AI capital expenditure don't materialize quickly. Before you buy any AI infrastructure adjacent stock, check 2 numbers. First, the debt to EBITDA trend, that's debt divided by operating earnings over the last 4 quarters. Is it rising? Second, the gap between CapEx guidance and actual revenue from AI products. If both are moving in the wrong direction simultaneously, that is the dot-com pattern wearing a different name. Wall Street's buy ratings are priced on the revenue upside. They are not priced on the debt downside. That asymmetry is the risk your portfolio is carrying right now. Subscribe for the next warning signal before it hits the headlines, and watch this one next.